Hi everyone, it's Valentina Sanchez Cuenca from the Bird Jobs Report. Welcome back to another of our weekly live shows with Craig Shapiro and Larry McDonald. Since 2010, we host an institutional live chat on Bloomberg with more than 660 investors in more than 20 countries. If you're interested in joining us or learning more information, please email Tatiana at thebirdjobsreport.com.
Hi, welcome back. Welcome back to The Lens with Craig Shapiro and Larry McDonald. Really excited. This week we got Matt Goldman's here, longtime friend. Keep in mind, we run an institutional chat and a Discord room with professional investors in more than 20 countries. So we've been doing it for a long, long time. We started this in 2010, and Matt's been with us a long time. He's in and out of public markets, but he's been extremely valuable over the years in the chat on Bloomberg with the institutions and his thinking and the way he looks at markets. We wanted to bring him in today. Craig is running the Discord room. Anybody that wants to join us, Tatiana at the beartrapsreport.com, get into the Discord, join us on Bloomberg, get into the conversation. We are democratizing information. We're crowdsourcing information every week with some of the smartest investors in the world. And we want to bring that lens out to a broader audience. And that's what we have, the One Idea, our new product. Join us at the One Idea. Join us on Discord. Matt Goldman, great to see you, my friend.
Likewise, great seeing you, Larry.
Tell the audience, we just spoke for a couple minutes off camera. Go back to, where you came from. You co-founded Elements, which is one of the most successful hedge funds, I think, and we have a lot of friends there over the years. But walk us through your career and what you've been doing, and as a quick introduction.
Sure. So started out at BlackRock. I was actually a computer programmer. This is what I studied in college, and after a few years moved to portfolio management. They put me in derivatives because they figured someone from MIT should probably do something geeky, and I ended up as a PM there for a couple of years, assisted with hedging and investments on different separate accounts. And then I moved to the sell side. I wanted to get an experience as a market maker.
Banks, right? Your Goldman.
Banks. I was at Citibank, yeah, and they had just bought Solomon, so they had a really good fixed income group, and it's very different sitting on the sell side from the buy side, and something that I feel like it's good to get a good exposure on both sides of the business in a career, and that's how I met Jeff. Who's
how did you start the hedge funds? And raise the cap.
Well, luckily we didn't really have to raise. I mean, Jeff had a great relationship with the head of a Madrid-based hedge fund at the time that was multi-billion-dollar, and he was able to secure an initial seed deal. And the seed deal was really generous at the time, and was 250 million, and it was we were part of a big platform, so they had multiple hedge funds there, and that's what we did. We left Citi and we started Element.
Excellent.
The good thing is when you start on a platform like that, you don't have to hire a whole ton of staff. They already have middle office. There were just four of us, and we were able to pretty much do everything that we needed to for at least a couple of years. But in 2 years later, I think it was a little less than 2 years later, we ran into some trouble. The hedge fund, the seeder, basically blew up or lost enough money that they needed to withdraw all of their capital from us.
Yeah, so they had a problem on the other side, and that's the thing with liquidity. When you have a liquidity event in one side, then it ripples through the markets.
Absolutely, and that's something that you really also don't get the perspective unless you sit in a seat where you've either been exposed to a liquidity event, or if you are in the middle of liquidity flows, typically at some of these larger banks, and we were stuck in a position where we basically had all our eggs in one basket. We lost our only investor.
Now,
and that put us on the road. So Jeff went out and started basically making calls and trying to find us replacement capital. We had a few months to kind of figure it out, and he did a great job of rounding up. I think it was Lehman Fund of Funds was actually our first investor. You would appreciate that, of course, and this was in 2007. So
what did you get the what was your AUM up to, assets under management?
Well, when we had to start over, we were under 100. I mean, we were able, we were raising in the tens of millions to replace this 250 million seed. So it was a step down, but the good thing is we had some solid performance already to lean on. Had that happened 18 months or 12 months prior, it would have been much harder to raise capital. So we were able to leverage what we'd done and bring in a smaller amount of capital and then basically grow it from there. And we continued to perform, so the capital kept coming in.
Now, in recent years, you've been involved with cloud computing software, and especially the last, 24 months, artificial intelligence, private and public, but startups. Let me ask you something. I think this is the most important question of the day, because everybody's long some of these public equities like NVIDIA. NVIDIA is still $200 billion larger than the German stock market, right? So everybody's long the same trade, the public market. The CapEx trajectory is what's keeping NVIDIA up there at 24 times sales. And the other Mag 7 companies are all anywhere between 6 times sales up to maybe 12 with Microsoft. So you have the Mag 7, they're trading at 6 to 12 times sales. And then you have NVIDIA at 24 times sales because of the expected capital expenditure trajectory from the hyperscalers, from the, obviously the Amazons and all the companies, the Facebooks that are supposed to spend and spend and spend and spend. The debate we've been hearing since last June was that we want to look for the warning signs as to the trajectory of this CapEx cycle. In other words, if it's going at 90 miles an hour for like a year, and all of a sudden it goes to 75, a stock like NVIDIA could possibly lose 30%, right? Because you're expecting that 90, maybe even 100 miles an hour of CapEx improvements and CapEx expansion. What are you seeing in the public and private markets in the last month or two to lead you one way or the other on this trajectory of capital expenditures?
I would say the problem that I see is really one of expectations and valuations. I don't really see anything alarming from the perspective of investment. There's still, in the private sector, we're seeing tons of companies, coming to market. They're creating interesting products. They all need heavy compute. And it's not something where we see any kind of pullback. Even the existing companies are spending more and more. And the public beneficiaries are guys like NVIDIA, and they're going to keep selling product. The problem that I see is really just that the expectations have grown, as you said, and valuations have gone up so much that there's a lot of capital already positioning for this wave to continue and get bigger and bigger. And all it takes is a little bit of a hiccup for people to kind of question the valuations and where their money is and how concentrated their risk is. Remember, a lot of people have huge gains on some of these stocks, and they don't want to take the gains as long as things are going well, because you have to pay tax in most jurisdictions. And so we're sitting here waiting, and all it takes is a bit of a rollover for people to get worried. The other thing that I think we have to think about is probably the biggest story of the week, which is the European infrastructure story, which I've been positioning for this actually since more than a month or two ago, because I anticipated that it's not about fighting the valuations here. And again, I don't see anything alarming in US tech or in the AI space. It's more about expectations.
Yeah. So let's broaden this out a little bit. So for the last 5 years, American exceptionalism has been driven by massive deficit spending in the United States, whereas in Europe, it wasn't like austerity, but it wasn't. I mean, the U.S. is running a 7% deficit, and the Europeans are running 2 to 3%, maybe in the case of France, close to 4. But American exceptionalism that brought in all that capital into the United States was really funded by deficit spending. So what you're getting at is if the U.S. is coming down, and this is a narrative that we've been hearing, and Craig, I want to ask this. I want to go to you, Craig. We've been hearing about this for like the last maybe month and a half, 2 months, in terms of okay, Europe fiscal expansion, U.S. fiscal contraction. That's what Matt's getting at, and that's why you're seeing this kind of all of a sudden value equities, the EWU, for example, a lot of MSCI World ex-US. There's a lot of, I think about, what did you calculate this week, Craig, in the live chat? 2.6 trillion has left the NASDAQ 100.
Yeah.
So,
yeah, no, I think, coming into this year after the Trump election, I think we were at kind of peak U.S. exceptionalism. It was, Trump's going to, all the good things about the Trump ideas, tax cuts, deregulation, supply side reform, bringing down energy, bringing down inflation, energy costs and inflation, I think was, people got very excited about that. And then as we started to, transition and he came into office, we started to see that narrative, the euphoria was priced, right? And so then we started to hear the narrative about, well, what about the anti-growth parts of the regime first, the deficit reduction, the immigration reform, the deportations, the tariffs. And so as you start to crescendo that peak euphoria about Trump, the narrative started to shift. And so we started to see some outflows from the US, and we started to see the dollar top out. And it was like Europe was waiting for a story, right?
What happened to animal spirits? I mean,
look, we exited the year with animal spirits and Bitcoin to above 100,000, and stocks are making highs, but we started to see some of those subtle shifts. And it was like Europe was waiting for a narrative. People were waiting for a narrative that they could really get their teeth behind in Europe. And we started to see some of that, in the charts early. But then over the course of the last couple of weeks, as Trump has raised the bar on, pushing back against Europe on defense, threatening at times to, stop funding NATO or leave NATO, or, what's he going to do, and, buddy up with Russia. It became more apparent, I think, to folks in Europe that, they were going to have to take on a much bigger role in their own defense and their own infrastructure and their own spending. And then post the German elections, which kind of secured that mandate, we saw earlier this week, the reform government kind of pushing forth with this debt brake, which will allow for deficit spending beyond, the legal limits, for lack of a better word, into defense and infrastructure. And so that really has really accelerated this trend that Matt was talking about.
So Matt, here's the thing about Wall Street, right? Sometimes I call it the clown show because there's very little independent thinking, right? They all go to the same country clubs. They all go to the Westchester Country Club, whatever. They play on the same squash courts. And there's just groupthink where they get into these. So from 2017 to 20, it was global synchronized growth. And they were pounding the table on global synchronized growth. And the dollar was weaker. And you had to be kind of invested around the world and the United States. And then we went into American exceptionalism from 2020 to 24. And where they were pounding the table on American exceptionalism, especially hardcore in January. And now it feels like we're going back to global synchronized growth, or some type of thesis on the sell side, where the sell side starts to, and I think we're in the early innings, where they start to pitch being more globally diversified. Matt, what's your take on that?
I think that the question in my mind is whether it's going to be a global synchronized growth or more of a relative shift in growth. Because I think there are reasons to also be bearish about the prospects here. I mean, we have, and this is of course speculation, and so it's hard to know exactly at the moment. But the administration here is focusing on getting rates down, right? Getting longer rates down. They're focusing on rebalancing and trying to get from public sector spending to private sector spending, and dealing with inflation once and for all, and cutting government expenditures. a lot of the things that they're doing are going to be growth negative if they follow through with them, right? And simultaneously, we have what Craig was just describing, which is essentially Europe finally found the reason they needed to step up and become more independent of the US and to actually move beyond some of these fiscal restraints that they've put in place. And so I think we have, it's a multipolar world, right? Geopolitically, there are realignments happening. And that means that capital has to align with those geopolitical realignments. It needs to go to the places where development and infrastructure need to happen. It needs to go to places where returns on capital are going to be stronger and where governments are allocating. Until recently, as you always said, Larry, right? Just look at the amount of capital that continues to be crowded into the same place, right? It's all US, in particular, mega cap tech. And it's been a great place to be. But it's not.
And you've been bullish the Mag 7 for all 2023, 24. You were right there. I mean, I
right. And so now it seems to me that capital is no longer in the best place. It needs to move into other locations. And that's what I think we're seeing. That's what the last couple of weeks and even couple of months have been about, is capital leaving. When we say stocks are down this year, not really, right? It's, US equities are down, really mostly led by Mag 7, where the most capital was just forced and crowded into. But plenty of stock markets are up. Like most of the things I own are up this year. And that's because the capital is already moving. And the other thing to remember about that is the amount of capital that's crowded into the US is really, really large. And so sometimes you see prices move and you think that, things must have already repriced. But, you can wake up one day or 1 week and markets gap higher. It doesn't really tell you that capital's moved. You've had a repricing. The capital may be still stuck here for the most part. And that's why our markets seem really, really heavy continuously.
And if you walk into the German finance ministry, for decades, there's been a picture of black zero, which is this austerity. It's a symbol of their dedication to austerity, black zero. And essentially, people have to understand, like, what did Lenin say? Decades can happen in a week, and weeks can happen in decades, something along those lines.
Right.
Lenin. This is potentially the most colossal secular shift in modern global financial economics, in the political sphere. If they're really going from black zero, which is the most hardcore austerity in the world, just think of what they did to Greece, grinding Greece. I mean, like beating them to a pulp on austerity less than a decade ago, right? And now they're basically giving carte blanche to European expansion of fiscal, and also it's off balance sheet. Craig, go through. There's a gentleman in our chat, London's chief investment officer, who's been writing in the chat. Craig runs our Discord room, and we run the Bloomberg chat. Please join us there. It's Tatiana at thebeartrapsreport.com. But it's really an off balance sheet vehicle to some extent. In other words, this isn't. In the old days, they didn't want to borrow money individually, or they were all borrowing money individually. Now this is like an off-balance sheet slush fund that's going to fund this expansion. Craig,
I mean, I don't know. Maybe it's too early to tell on some of that, but I think broadly speaking, we're talking about levels of spending from Germany and then likely from other countries that just haven't been done before. And so I think the big question is, there was obviously a very big move in European sovereign rates, over the course of the week. We see a very large move in Bund selling off, in Buxel selling off, and Oat selling off. And so as the market comes to grips with this reality that deficit spending is coming, higher yields, right? How is it going to be funded? Is it going to be funded by European banks? Is it going to be funded off balance sheet? But no matter where it's going to be funded at higher interest rates for Europe. I mean, Europe has European rates have been broadly below US rates now for several years. And so as Europe is moving into a pro-fiscal, pro-growth spending narrative, while the US is moving the other way, shifts in interest rates, will have big implications for the dollar, for dollar euro, and for these flows that Matt's been talking about. So, the question is, as Europe is spending, where will the money come from and how expensive will it be to borrow? And I think that's, investors are grappling with that reality now. And typically what we've seen over the course of the last few years is as interest rates have risen, we saw this in the UK gilt market. We even saw this here in the US back in the third quarter of 22 and 23 as yields went, up toward 10-year yields went up towards 5%. Risk markets started to, not like that, right? And so as yields move higher, equities, can come under some pressure. And so the question from here is how much is already priced into this growth, and as yields move, are we facing some headwinds?
So yeah, I think that's a great. If I could just add one thing, I think that's a great point because looking at the bond markets to me the bond markets are really core to everything in the economy, and they're where we can see the price of money, and the fact that European rates are going up, I think it's a good thing. Rates had been low for the reason that we've outlined already. In Europe, they hadn't been spending sufficiently, and the rates were below where they probably should have been for a very healthy $20 trillion economy that was making the most out of itself. And so we're seeing them go back up. Now, I mean, as of now, I think it's healthy and indicative of what we've been talking about and seeing the future spending needs, partly increasing the price of borrowing, but also pricing in a higher growth trajectory for the Eurozone. And so I look at it as relatively healthy so far. If this were to spike and continue to go to the point where they were materially at or say above the US and it became problematic for countries to actually issue debt, whether it was Germany or maybe Eurobonds, then I think you start to run into concerns about valuations and also the ability for them to even execute. But I don't think we're anywhere near that.
So if this is a secular, colossal moment where capital is going to start moving in another direction, Matt, the DCF model, discounted cash flows, one of the points we make in When Markets Speak, our new bestseller, it's up on Amazon. It's doing really well now because we get into the whole multipolar world that you're talking about. Thank you, brother.
I have it with me here for inspiration.
That multipolar world with higher yields and more sustained inflation, if we're in that regime, the DCF models across Wall Street that all the analysts use, they're really, that risk-free rate globally and in the United States is kind of the trigger for that model. So if we go back to a 1968 to 81 regime with higher yields globally, a little bit more elevated inflation, explain, number one, what you think is if you think this is in the works. But if that's the case, then that model that the entire street uses with a higher risk-free rate, up at a different level, then does that create a flow more to global value or different types of portfolio construction?
I think that's right. I think it just really assists in justifying a lot of the capital reallocations. The markets have forced capital into a lot of these very long duration assets with very low discount rates, some of them artificially low. And if we have a period of time, I mean, inflation has been above target and never got back to target here. It's, arguably maybe it's picking up a little bit. We've certainly seen some surveys that indicate that maybe we'll start to actually creep a little higher again. But regardless of whether we do, it's certainly, above where the goals are. And that's a different environment. It's not a bad one. I don't think it's a bad one for risk assets. I think it's a bad one for risk assets that rely on very, very low and artificially low interest rates, but not for, as you said, certain global value plays. And some of these valuations have gotten really extreme to the downside over the past, 3, 4, 5 years. So I just view there's a lot of catch up to do. And if this is a legitimate force that comes about, I think there's going to be a lot of movement in relative asset prices.
Steve Kalajian made a point today. So we have a lot of contributors around the world. What we do in the chat is there might be 600 people, 600 to 800 people in the chat, but maybe 30 or 40 of them contribute. Some of them are family, some of them run family offices. Some of them are, we have a couple of guys that used to be at More Capital. We got a couple of guys that used to be at, worked with Tepper, and they contribute. So it's kind of cool. It's kind of like, it's like a live ideas dinner. Tatiana at the beartrapsreport.com if you want to join us on Discord or in the Bloomberg chat. But Craig, this morning was interesting. There was a technical level that Kalajian mentioned, and then I ran that by 3 or 4 funds, and they did agree that if we close below that level on the weekly, then we're potentially at a moment where you're on the other side of the mountain. And all that means is in a bull market, you want to buy the dips, and that buy the dip psychology gets more deeply entrenched in thousands, if not millions of investors. Once you go to the other side of the mountain, technically, I want you to address this, Craig, then you're in like this sell the rips mode and other side of the mountain. And there was 2 CIOs in the chat that have been pounding the table bullish the last year, that were really bullish on the economy, even when Jamie Dimon was screaming hurricane, remember? And Elon was like a year and a half ago, 2 years ago. These guys were really bullish in the chat, and now they flipped to bearish for a whole bunch on U.S. assets. They think we're going to be in a sell the rips mode. Craig, explain that conversation that was going on in the chat today.
Yeah. Look, I think, you and I in the chat, and I think the narrative that we've been picking up has been about this growth slowdown, this uncertainty from the Trump administration that's leading to some of the survey weakness, some of the business confidence weakness, some of the consumer confidence weakness. And so we've been picking up on that. It's starting to show up in the soft data. It's clearly been showing up in equity price momentum. We've talked about these relative value shifts and movement out of the dollar and dollar assets. But now it seems like from a technical profile perspective too, we're starting to see a lot of charts looking poor. I think our colleague this morning made a reference. He does a ton of chart work. He says he can't find a chart that looks like it's bottoming, right? Almost every chart looks like it's topping. And I was reminded of this this interview that Paul Tudor Jones did on Black Monday in 1987 from the floor of the stock exchange. And he made this unbelievable point, which was if you were an investor in the 80s, you would have only made 2 decisions. He said, you would have bought the market in August, I think, of 1982 when stocks went above the 200-day moving average, and you would have sold them basically on the Thursday before Black Monday when stocks went under the 200-day moving average. And so it's just so happened, not to obsess about the 200-day moving average, but this is for the first time S&P, NASDAQ, and basically all the U.S. indices are likely to close under the 200-day moving average on a weekly basis for the first time really since the fall, I think, of 2023. And maybe even earlier than that for the S&P. So it's been a long time since we've been trading under the 200-day moving average. And so I think it just caution wears. It basically, people need to think about how the momentum, how the markets, how the technical profile has shifted. And it just so happens that we've coordinated around some of these levels. And Steve, who mentioned that this morning, his level happens to be very close to that 200-day moving average. And so we're at a critical juncture here.
And just remember, the bull market's been so vicious that there's very little short interest. So if you look at on Bloomberg, if you go SPY in the space SI or QQQ space SI on Bloomberg, I mean, you go back 20 years. This is one of the periods where there's very little shorts. And what happens is, in bull markets at the end, people have been covering at the 200-day, covering the shorts, which is fine. And that's why you've had these beautiful bounces off the 200-day. But when you destroy the bears to the point where there aren't any left, there's a little bit of covering at the 200-day, and then there's no speed bump on the way down, right? Because all the shorts have been carried out. There's nobody short. If there's a lot of short interest, we saw this in like 07. A lot of people were bearish in 07, Matt. And there was so much short interest that. But it took a long time for the market to really break down in a way because the shorts kept covering, right?
That's right. Yeah, bears have been taking bears have been taken to the woodshed so many times. They're just there's nothing left. And I would say the opposite about certain other markets, right? There's no bulls anymore. Like we got to a point where you couldn't find a bull on China or European equities if you like went to like, an entire stadium. Like there wouldn't be anyone. And that's why you see these sharp rallies too, because there's nobody to sell. It's the same. It's the opposite of
Right.
what you just said, right?
There's no stock to buy.
There's no profit taking.
European equities, there aren't any, you can't even buy. They're very difficult to buy because, like you said, all the longs have been carted out, and the real investors are in there, right? But any kind of first has been taken out of European equities, right?
Right. So now we're in a position where we have, and again, this is where I go back to. The rotation to me is my strongest view. It's been my strongest view since early at the beginning of this year, for all the reasons we've talked about, and the geopolitical realignments and U.S. isolationism, et cetera. It's all that was my biggest thesis. The question is, how does it happen? Does it happen with U.S. equities continuing to fall as people capitulate one by one and just take their profits, pay their taxes, and move on? Or is it going to be more of a globally driven growth where you have now a second major center of fiscal spending, and it's not just the US pulling everybody along. And so it's an argument for maybe everything to do well. Let's keep in mind that Europe, if they spend the money that we're talking about, hundreds of billions of dollars, maybe more over the coming years. First of all, a lot of that money is going to go outside of the Eurozone, at least initially, right? They don't have the production capacity, as far as I know, to build the kinds of military equipment and scale that they want to build, or that they would want to build. And US contractors do, right? So some of that money comes out and goes over here, or maybe to other parts of the world. Second, they will spend money on other infrastructure. It's not just about military, right? We're talking about modernization. There's going to be energy infrastructure. Once you break the seal, this thing can run for a while, and it turns into even domestic consumption, right? We've seen that in the US, right? All this fiscal spending really drives a lot of domestic consumption. And the Europeans I don't think will be any different. And so, that benefits global companies, right? So S&P 500 is a tremendous amount of global revenue. It's really not just US. And so that's why to me, it's more, I'm not very, very strong about whether I think the US is going to, markets are going to go down a significant, 20%. That's not, it could happen. And a lot of it depends on the US policy. I think there's a lot of uncertainty now, right? I've seen some of these uncertainty indices.
Matt, if you try to balance the budget in 1 year.
So that'll be an epic recession, right? So yeah.
That has to be a fancy.
I think my read on it, and I'm not a geopolitical expert, but my read on it is that these guys are talking tougher than they will end up acting.
Yeah.
Everybody knows that, certainly in the first term, Trump was very sensitive to the stock market performance. And the other countries have said even publicly that they know this. And so the negotiation tactics are all about, how much pain can I inflict on the other guy? And so our administration has to project that they don't care about the stock market,
right?
And that they're willing to, and it's even their goal to inflict pain, and that their goal is to bring rates down and cause, S&P to fall. So they're going as far as to say that. I don't believe them yet. I think when push comes to shove, they do not want to be responsible for pushing the U.S. into a recession. They do not want to be responsible for a large equity drawdown. So if given that, then I don't actually see a reason to be very bearish overall. I think it's a capital reallocation. I think other markets will outperform us significantly. but it doesn't necessarily mean that we're going to see a big drawdown here. And but that I would say that the longer this uncertainty hangs over us, the more damaging it will become, and the harder it will be to put the toothpaste back in the tube.
Yeah, and on valuations, I mean, you have copper names, you have names like Vale, or VALE Equity. It's a obviously Brazilian-based company, but you're trading at like 9-10% free cash flow yields.
Incredibly cheap. Yeah.
Weatherford, right? WFRD trading close to a 13% free cash flow yield. I mean, they could take. In some ways, some of these companies. Einhorn's a great investor. He's talked about this in my book. David Einhorn, I think he's just, to me, he's just a Hall of Famer. And he talks about like some of these companies, there's not a bond floor or anything underneath, but when you're running a 10, 11, 13% free cash flow yield, and there's a certain amount of public equity, at some point you can just buy the stock back. I mean, we're seeing that with companies like Antero, AR Equity in the natural gas space. They've already bought back 11, 12% of the stock, you know what I mean? So, because they're producing so much free cash flow. And so, we've gone through a period where everybody's focused on AI, but nobody's focused on kind of the infrastructure that's going to support AI for the next 20 years. And that's
energy.
That's what we're looking at.
Yeah, and that's the question. The thing that I wonder about there is energy is all this infrastructure spending, and whether it's AI or otherwise, is going to require obviously a lot of energy. That's something we know. At the same time, we have policies that are going to attempt to increase energy production significantly. So that's why I'm actually not sure. I don't have any significant positions in energy at the moment. And as much as they're very cheap looking and they should benefit from this fiscal, I'm not sure how to play it because of the other side of that.
Yeah. Well, it's tough. Remember, there's 105 trillion of GDP in the world. There's about 30 in the US. So if the world does rebalance the other way, what we saw from 2017, 16, 17, 18, there was kind of a period of a weaker dollar. And if the dollar breaks, which it looks like it just did, that candle this week, it looks like a secular punch, and if then these commodity type equities will be supported just by alone by the weaker dollar, if
right.
you want a secular bear market for the dollar.
And the dollar is interesting because I think the original thought process was that we're going to have a trade war, tariffs, it's going to increase the dollar. In fact, that would have been helpful for the administration, and continue to allow inflation to remain below 3. Maybe it doesn't go to target, but at least offset some of the increase in prices from tariffs directly. But now we're seeing what I think the real trade is that was a sideshow. I think the real trade is this loss of U.S. exceptionalism in the capital markets, and money's flowing out of the U.S. into these other markets, and that's driving the dollar down. Because remember, Mag 7 and strong dollar were one and the same in a lot of ways, right? And so now we're seeing the opposite effect. But all that's going to do is further raise our import prices and create more complexity for policy. So that's the other side, and I'm not sure how that's going to be handled, because it makes we're doing is pricing in more and more Fed cuts every day, and it's going to get harder to look at the world that way.
Yeah. Now we wrote about that in the One Idea this week. We talked about repatriation. We talked about now that there's a narrative around Europe.
And Craig, what is the One Idea? Just for the audience.
Yeah. The One Idea is a weekly snapshot. It's a weekly idea, that we come up with based on our chat, based on our conversations, based on what we're hearing and thinking from in the markets. And it's a theme, for the idea. Maybe a trade idea, maybe just a thematic, maybe some words of advice or some the market narrative, but it's one idea per week. We try to publish on Thursdays. It kind of gives a sense of a flavor for kind of the biggest picture thing that's going on in the chat. And so this week we definitely have picked up on this narrative, this shifting geographical narrative. And so the repatriation of capital out of the U.S. into areas that now have a domestic narrative, right? Germany now has a domestic narrative on defense and on infrastructure spending. China also this week talked more about consumption spending and creating this domestic narrative, maybe about shifting the composition of their GDP from export to consumption. We know Japan similarly is going to have to spend domestically on defense and on consumption. And so now you have this this narrative. All that capital that foreigners have been putting into the U.S. has a reason now to go home. And so we're seeing that as capital leaves the U.S. and the dollar starts to weaken, that benefits from a longer term perspective, where I think Trump and the administration wants to be on the dollar and wants to think about bringing back manufacturing, reshoring, jobs back here. The question is the path to get there. And as capital flows out, I mean, the U.S. is in a massively negative net international investment position, meaning that foreigners own a tremendous amount of our assets, close to 70% of GDP. And so as they are selling our assets in order to bring that capital home, and the U.S. stock market and potentially U.S. treasuries come under pressure, yes, it's creating this weaker dollar environment that's going to help us longer term. But from a short-term pain perspective, if our equity markets are coming under pressure, how much is the administration going to like that? And I think that's the ultimate question. Bessent was out this morning saying there is no Trump equity put. We'll see. We'll see how much pain tolerance this administration has for softness in the equity market. I think they're fine blaming the prior administration for the froth and the bubble in government spending. And so I think there's a window here. Larry, you've been talking about this for months now, about front loading the pain as far away from the midterms as possible. But if this starts to spiral a bit more out of control, now that the technical profile of the market is under concern, if this spirals, how much tolerance are they going to have for this?
I just saw a headline. NVIDIA has now lost $1 trillion of market cap. So think about that. NVIDIA is almost like an ATM for the global equity sphere. So it's like an ATM. People are going to, they're taking, it's like a funding mechanism. They're using NVIDIA to funding their investments, outside the United States or something along those lines. But great to catch up, guys. Join us next week. The Lens, Craig Shapiro, thank you so much. Matt Goldman. We're here every week. We want to recap the intelligence gathering from the live chat. Join us on Discord. Join us on the Bloomberg chat. Tatiana at thebeartrapsupport.com. And have a great weekend.
Thanks, Larry. Thanks, Matt.
Guys. Have a great weekend.
If you're interested in any of the reports mentioned all throughout this video, or you want more information on our subscriptions and research, please email Tatiana at thebeartrapsreport.com, as you can see here on the screen. Many thanks for joining us, and I'll see you next week. Bye.